Hey everyone, welcome back to Corporate Dakota. Today, Peraso Incorporated just filed an 8K announcing a material definitive agreement, and I'm seeing a move that could seriously impact their share price. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing reveals Peraso is setting up a way to sell up to $25 million of their stock, and it gets interesting when you look at the details. So, Peraso Incorporated, a company in the semiconductor space, is letting everyone know they have signed a deal with Roth Principal Investments. This isn't just a simple announcement, it is about raising capital, and the way they plan to do it has some big implications. It is essentially an agreement that allows Peraso to sell new shares of its common stock to Roth Principal Investments over time, up to a total of $25 million. The key here is that Peraso gets to decide when and how much they sell, which gives them a lot of control. This agreement, called a Common Stock Purchase Agreement, was signed on June 30th, 2026. It's basically a flexible lifeline for the company. Peraso can tap into this funding whenever they feel it is the right time, and they don't have to sell any shares if they don't want to. This is pretty different from a standard loan or a fixed stock offering. Along with the purchase agreement, there is also a registration rights agreement. This part is crucial because it means Peraso has to file paperwork with the SEC to register the shares they might sell to Roth Principal Investments. This allows Roth Principal Investments to eventually resell those shares in the public market. Without this, the shares would be restricted. The company, meaning Peraso, has the option to sell shares. They can decide to sell shares on any given trading day for up to 36 months, starting from when certain conditions are met. They have to give Roth Principal Investments a heads up though, and there are rules to follow. Here is where it gets really interesting. The price Peraso gets for its stock isn't a fixed number. It is based on the volume weighted average price, or VWAP, of the stock during specific periods of the trading day. And on top of that VWAP, there is a discount for shares sold in what they call market open purchases. This discount is 3%. This means Peraso is essentially agreeing to sell its stock at a price lower than the market average, which is a form of dilution for existing shareholders. Then there are what they call intraday purchases. These are similar to the market open purchases, also at a discount, but they can happen at different times throughout the trading day. The discount for these is also 3%. This just adds another layer to how Peraso can sell its stock and how the price is determined. They also have pre-market purchases. These are done before the main trading session starts, and the discount here is a steeper 6%. And finally, post-market purchases. These are executed after the market closes, and again, there is a 6% discount to the VWAP. So depending on when Peraso decides to sell, they could be selling at roughly 3 to 6% below the market price. It is important to note that the price can be adjusted for things like stock splits or dividends. But the core idea is that Peraso is selling stock at a discount to market prices, and they control the timing. Now, this is a really big deal for shareholders. NASDAQ has rules about how much stock a company can issue without getting shareholder approval. Peraso can issue up to about 3 million shares, which is nearly 20% of their outstanding stock, without a shareholder vote. However, if the average price Roth Principal Investments pays for the stock goes above a certain threshold, specifically $0.9853, then this limit doesn't apply. This means they could potentially sell a lot more than 20% of their stock if the share price is high enough. There is also a cap on how much Roth Principal Investments can own at any one time, 4.99%. This is to prevent them from immediately becoming a major majority shareholder just from these purchases. To make sure all this is done correctly and legally, Peraso has hired Digital Offering, which is a registered broker-dealer. They will act as an independent underwriter, which is a standard practice to ensure compliance with financial regulations, especially FINRA rules. This adds a layer of legitimacy to the offering. Now, let's talk about the costs. Peraso has to pay Roth Principal Investments a commitment fee of $500,000. This is basically 2% of the total $25 million commitment. They are paying this fee not all at once, but by Roth Principal Investments withholding 10% of the total purchase price of each stock sale, until that $500,000 fee is fully paid. On top of that, Peraso is also reimbursing Roth Principal Investments for their legal fees. They've already paid $100,000 for the initial setup of these agreements. Plus, they'll pay up to $7,500 each quarter for ongoing legal work related to due diligence. The agreement has an end date. It will automatically end after 36 months, or when Roth Principal Investments has bought the full $25 million worth of stock. It also terminates if Peraso's stock gets delisted from NASDAQ or if the company files for bankruptcy. These are pretty standard termination clauses for this type of agreement. This is where they discuss the unregistered sales of equity securities. The shares being sold under this agreement are not going to be registered with the Securities Act. This is because they are relying on exemptions that say these sales are not public offerings and are being made to accredited investors. Basically, They are saying these sales don't need the full public registration process. The company also put out a press release on July 2nd, 2026, talking about this whole deal. This is just their way of informing the public more broadly about the agreement. Like most filings, this report includes forward-looking statements. These are basically educated guesses about the future, using words like believes or expects. They are telling you that these statements involve risks and uncertainties, and the actual results could be very different. This is a standard disclaimer to protect the company from liability if things don't go as planned. Finally, let's look at the exhibits. The most important ones are Exhibit 10.1, which is the Common Stock Purchase Agreement, and Exhibit 10.2, the Registration Rights Agreement. These are the actual documents that lay out all the nitty-gritty details of the deal. They also have a press release as Exhibit 99.1. Now, looking at the financial context, Peraso Inc. is a small company in the technology sector, specifically semiconductors, with a market cap of about $12 million and a current stock price around 82 cents. They have around 42 employees. Recently, there have been headlines about Peraso securing up to $25 million for drone and defense work. And establishing this equity purchase facility, this filing is the confirmation of how they plan to achieve that funding. Top institutional holders like Geode Capital Management and Vanguard have a small stake in the company. So what is the story here? Peraso needs cash. And they found a way to get it by selling stock over time. The good news for them is they control the timing and the amount, and they can use this flexibility to try and get better prices for their stock. They are also planning to use the proceeds for working capital and general corporate purposes, including product development in the drone, defense, and tactical communications markets, which aligns with recent positive news for the company. However, there are some definite risks for existing shareholders. The most significant is dilution. Peraso is selling stock at a discount, and they can sell quite a bit of it without a shareholder vote. This means the value of existing shares could be spread thinner. The fact that they can sell nearly 20% of their stock without a vote is a major point to watch. If the stock price stays low, they might not be able to raise the full $25 million, or they might have to sell a significant amount at a discount. The comparable situation here is any small early-stage tech company needing capital before they are profitable. Many turn to these types of equity lines of credit. Historically, about half of microcap companies that rely heavily on these types of dilutive financing see their stock struggle, or eventually delist. A common pattern is a steady, slow grind, down as shares are issued and sold into the market, which can put consistent downward pressure on the stock price. If Peraso sells, say 5% of its outstanding shares in a given period at a discount, that is a tangible dilution occurring that often doesn't get immediately offset by positive business news. The risk I am watching is how aggressively Peraso utilizes this facility and at what discount. My biggest concern is the long-term impact of consistent share issuance on the stock price and shareholder value, especially if market conditions don't improve. What I'm actually looking for is evidence that Peraso can execute its product development and sales strategy effectively to justify this dilution and drive a higher stock price that would allow them to secure more favorable terms, or even avoid further reliance on such facilities. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.